let's take another look at today's massive sell-off. Stocks dropping hard after this morning's hot inflation report. The Dow falling nearly 1,300 points. The S&P plummeting more than 4%. The tech-heavy NASDAQ seeing the worst of it, down more than 5%. But energy stocks saw relative strength today, falling less than the rest of the market. Our next guest says that could be a place to hide out amidst this broader market volatility. Let's go off the charts with Chris Verrone of Strategas, a Baird company. Chris, great to see you. Which charts are you looking at?
Hey, Mel, well, I think we have to start with the action of the day is obviously what we saw in the broader market. Now, if we just put this in a little bit of context here, our thinking has always been when you're in a bear market, when you're below what is still a downward sloping 200-day, the risk to a surprise tends to be on the downside. We certainly got that surprise today. We've been talking about this 3,900 level as major support, but let's talk about this a little bit differently for a second. Let's think about leadership. If you look at the rally the last 4 or 5 days, what underperformed? FANG and semis. On the way up, they lagged. What lagged today on the way down? FANG and semis. So this market is more about just calling levels. It's about recognizing what is and what isn't leadership. The triple Qs, the FANGs, the semis lagged on the way up and lagged on the way down. That is not where we want to be in this market. So where can we hide or where can we find relative value? I still think the energy stocks provide a really good example of that here. And what we've been particularly impressed by is how energy has disassociated itself with crude. Obviously, we had crude lower over the last several months. Crude actually made a lower low last week. What has not made a lower low are the energy names. They've been able to disassociate themselves from crude weakness. We think that's the energy sector telling us that the structural tailwinds to the sector are more important than perhaps the cyclical headwind of lower crude prices. And, you know, if you look at the flow picture, what we've been really surprised by is the degree to which investors have just liquidated their XLE. So these are flows into the XLE over the last 3 months, just complete liquidation. So there's a lot of skepticism here. We like that from a contrarian standpoint. And then I think very importantly, in a market where it's really hard to find good charts, 95% of the energy sector is still above the 200-day. So we like to fish or hunt in the areas that are most fertile, and I still think energy continues to emphasize that. 2 names I'll show you here real quick. ConocoPhillips, what's most important for us in a down market is finding relative leaders. Conoco, relative to the S&P, is right back at the highs. You have to say that's impressive. I'll give you one more here. This is Hess. Not only is it back at the relative highs, it's back at the absolute highs. Both names were outperformers today. They've been outperformers all year. This is a tough market. Seek out leadership. Avoid the weak charts.
It's a great metaphor. Fish or hunt where it's most fertile. Going back for just a second, Chris, to technology broadly. If technology is no longer leadership, what does that mean for technology specifically in terms of performance?
Well, Mel, I think the reality is tech has not been leadership for almost 2 years now.
Right.
I mean, the blow off top, at least in the relative performance of FANG and ARC, I mean, that dates back nearly 2 years. And, you know, our big call all year has been avoid these semis. These semis are finished. They've been leadership for the prior decade. They're not leadership here anymore. NVIDIA, AMD, Broadcom, Qualcomm, major top formations, both in the absolute and the relative sense.
All right. Chris, great to see you,
Thank you.
In person. Chris Verrone of Strategas. So, Tim, just extrapolating, I mean, semis are an indicator, leading indicator of the economy. You've always said this is what you tell me every single time, Tim. And here we are. Chris is saying, forget him. Forget him.
Sometimes people refer to that as redundant. Otherwise, we could call it consistent. And I just think, you know, and you look at that NVIDIA chart, as Chris referenced, it actually took out those September 1 lows and actually are building on the July 5th lows where the market actually bottomed before going on a big run. It's tracing lower, and he's right. The other thing that Chris said, just when a charts guy, and we love Chris, let's be clear. So when I say this, when he starts talking about structural tailwinds, he's talking about the fundamentals. He's talking about as an investor, not a trader. And if you think about what's been going on in the energy sector, something else I like to harp on. Think about ConocoPhillips with $14 billion in net debt is actually going to, at $80 oil, will pay down $6 billion in debt, will grow their dividend 8%, and will buy back 20% of stock in the next 3 years at $80 oil. And this is all happening with the dollar that's at all-time highs or 20-year highs or 18-year highs, whatever you want to say. Each 1% move higher in the dollar equals a 3% move lower in oil prices. So oil's been trading yeoman-like in this environment.
Yeah, I mean, I think what you're saying is true, is that if you're looking at fundamentals, for sure, there are some tech businesses that no matter what happens, they're going to be structurally sound. They have everything they need. They are fundamental players. They are mission critical software, for example, things that you're not going to replace. And so when I think about the fundamentals of those businesses, even in a difficult economy, they're better positioned. But if I think about energy, and if, let's say, suddenly, Putin decides he's going to pull back from Russia, from the Ukraine, what does that mean for oil prices? And is that really a fundamental driver? And is that a place that I want to be in? Not really, no. So I think I'm trying to pick businesses where they are masters of their own destiny rather than ones that can be influenced by so much volatility and outside factors that are especially in geopolitics.